truly risen at all. And in relation to if there's the perception that inflation has risen at all, we have to keep in mind that in the longer term time frames, the dollar is inside of this massive monthly support level. And then inside of that, it is inside of this gigantic daily support level. And what's interesting, the last time that we were inside of this support, we went right to a line in the sand and then ripped away from it. And that is what put our highs in previously, our previous highs for the year in. When we had made this double top up here and failed to break out of this previous high, that's when the April rally started. And we have been inside of that rally since, which is why we're trailing this series of shorts so tightly here as we're going into the rest of this week. If the dollar continues to decline, we are anticipating that the indices will continue to rise. You'll get a little bit more clarity when you're looking at the euro in this relationship, because it has been very technical inside of its opposing longs. So DXY is just a mashup of a bunch of currencies. The euro is more than 50% of DXY. As you can see here, these lines in the sand, the euro's longs equal or are the equivalent of a dollar weakness trade. And as long as the euro keeps grinding higher, the indices will continue to grind higher as well too. So that trend is continuing here as we're going into the beginning of this week. You might even be able to make a case that our overnight lows to highs have defended multiple pullbacks here as we've come out of our morning timeframes. But the bigger picture is that we would not be able to confirm that the indices were doing anything as in breaking their trend, their bullish trend, until we broke below these 1722s. So it's the euro that's important. Bank has fallen right back down into a long setup here, and this is a gigantic bull flag that it has been inside of for weeks. Rallying away from this low and defending this support level is bullish for the indices. It continues to be as we move forward here into the week. Nothing is broken. In fact, we've actually made a pullback. When we're thinking about this in VIX terms, the VIX is very quiet, but it is going into an expiration here next week, Tuesday. So we are in rollover as we go into the close tomorrow. Many times you will see a rollover on the VIX being very bullish initially for the indices, because market participants that have been long volatility for protection against, in theory, their long positions on the indices, they're not shorting a market that's going straight up. There was a question earlier this morning, why is there such a, or what are the thoughts behind the big divergence? Well, the markets have gone straight up for 40 days, and there's a lot of market participants that are a part of that rally in varying forms, some in more profitable positions than others, from lower inside of that rally. And now we've reached consensus. Everyone is agreeing. There's nothing bearish about the markets. Well, that's the point of maximum financial risk, when everybody agrees. Kind of like March 31st, when we were completing all of our short targets and there was nowhere left really to fall. We started breaking short setups, and we have been in a rally from those levels for 40 days, almost 40 days. So where is the trend break in relation to the VIX's downtrend? Well, in the continuous contract, it's a 1995. But if we look at where the new contract... This stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.